The slippiness of the S&P markets, because of the way that the S&P is structured, we normally have a skew that looks like this. So this is normal for stocks. If this is the index, then this is stocks as well, right? Now, if I said to you, what's the probability on an earnings report, what would it look like? So just do this as an exercise for me, please, guys. If I said to you that this is the at the money, if I said to you that the at the money was here, do this as an exercise, as a thought exercise. You can write it down if you like. If I said to you that there was a high volatility earnings, so in other words, implied volatility was popping, right? Implied volatility was very, very positive. And we have a negative skew. What would this report look like on this screen? A negative skew. In other words, a bearish skew. What would it look like based on the SPY storyline? Bearish skew. What would it look like? Draw it down on your screens, or draw it down on a piece of paper, or at least have a visual in your mind's eye about what it would look like. And obviously, we'll now look at what it should look like in terms of this skew. If we've got a negative skew, right, if we've got this kind of idea of this being a negative skew, this should be relatively straightforward. Obviously, it's going to be a really high implied volatilities. Has everybody at least got an idea about what it looks like? Well, let's think about it. If it's high implied volatilities, one would imagine that the skew will look very much like this. Would that be reasonable? Would that be reasonable? Is that what everybody would imagine the skew would look like? Now, you may be saying, but why the rally at the back end here on the calls? The rally on the calls here is because it's an earnings report. It could surprise significantly to the upside, couldn't it? So in other words, the implied volatility isn't all negative. It's implied volatility, but it certainly has a very negative skew attached to this. In other words, the probability of it staying around about the same price is almost zero, right? Does everybody understand that? The chances of the stock staying at the current price are almost zero. Does everybody understand that? So obviously the probability is that it's going to extend on both sides potentially, significantly more so on the bearish side. So if everybody understands that, well, at least two people understand that. That's a good start. It's better than nothing. And we can obviously think about what a bullish skew would look like. Well, it's going to be just the exact opposite, isn't it? So if we look at a bullish skew, we would obviously understand very simply that the skew would probably look maybe a little bit like this. So we'd have something that looks maybe a little bit like this. Right? So we get this idea that that's what a bullish implied, because obviously there is downside risk, slightly more than normal. But obviously with a bullish skew coming into play, we can now understand that the probability is very high that we're going to go to the upside, right? Well, take a look at FUBO, this 20% winner for us. Okay, so this 20% winner for us. Take a look at this trade. Sorry, the trade from yesterday that we showed you just a short while ago. Let's take a look at that as a potential trade outcome. Okay, so FUBO. Let's take a look and see what FUBO did. What do you think? Bullish? So do you see how easy it is to see these elements? I mean, it's not exactly an in-depth study of deltas or any other analysis, right? It's a simple graphic display suggesting that the price, the implied volatilities, okay, implied volatilities on the left-hand side, there it is there. The implied volatilities as you go through the deltas is increasing significantly more at the top line, right? Which means that this is also another word for what? Probabilities. Do you agree? Implied volatilities is probabilities. So if the probability is higher on this side, I have an edge to this trade. I have an edge to buying this trade. It's not a guarantee, but I have an edge to buying into this as a bit of business, right? So obviously, if I've got an edge to buy into this as a bit of business, well, that's the trade I've got just now. This is this trade here. There's FUBO, and there's the trade. So buying at $3.20, it's trading at $3.90. 70 cents profit on a $3 stock is 20% return on my money. So we did 20% yesterday, and we're now doing 20% again today. That's another $20,000 paid into my, well, £20,000 paid into my account at the cash open when we cash this one in. 20 grand paid in. 40 grand in 2 days. 2 trades, 2 equity trades, £40,000 more. And it's literally not even 2 days. It's basically just over a period of 24 hours. So we can see that these are all possible, doable ideas. We can see that this is unusual. It still has downside risk. We understand it has downside risk. But also when you look at that stock, does it not look like an accumulation stock? Does that pattern not look like an accumulation pattern? The fast money move of the open cash open there, the slow grind lower, and every time it went lower, there was institutional buying, and then the capper coming in, and then the slow grind lower and institutional buying, and then the capper coming in, and the slow grind lower and the capper coming in. Does it not have a fast, slow narrative to lean against? The answer is it has all those components, doesn't it? In other words, it's not just about the skew that's on the trade. It's not just about the implied volatilities. We can also recognize that fast, slow storyline. We can recognize that the whole entire day seemed to be built up and around this trade taking place. And it did. And the outcome is superb. The outcome is absolutely superb. A fabulous, fabulous upside outcome. That is a great trade. And it's added to the list of some great trades we've had. Very, very simple stuff, very simple narratives, very simple storylines. And it all comes down to a simple graphic that you can understand from this little chart here. And you can see that storyline element developing into this as a product. And as the storyline develops into this product, we can see whether there's an element of bullishness, an element of bearishness. We can recognize how strong the trade is, and we can recognize the outcome that came from that bit of business. This, to me, was one of the clearest we've seen in a while. And obviously, it's given us a lot more than the implieds suggested. Because as I said, the implied was suggesting that this was going to do 17%. It's done a little bit more than 17%. So that's nice. So with an implied of 17, you got to like that bit of business, haven't you? You've got to like that bit of business. Now, actually, this wasn't the classroom I wanted to do, so we're going to take a little break, and then we'll do the classroom that I intended to do before the cash open. We'll squeeze in this classroom in the next 30 seconds or so. We'll get another classroom done before the cash open today.